There are many, many videos out now about how to buy iBonds. There were a whole slew of videos that came out about how I bought iBonds yielding 9.62% in 2022. Everyone was jumping in to buy iBonds. I was really tempted and I analyzed the iBonds, and after so many years of low interest rates, it was really, really tempting. But I stepped back and I said, well, wait a minute. What are the disadvantages of buying iBonds, even though they're yielding 9.2%? It's easy to jump on the bandwagon with what everyone else is doing, but I like to sort of step back and say, does this make sense for me based on what I know after investing for several decades and the macroeconomic picture? So in this video, I'm going to share with you why I did not buy iBonds when they were yielding 9.62%. What are iBonds? I'll just tell you really quickly. They are issued by the U.S. Department of Treasury. The interest on iBonds is determined by using both it's a little bit of a complex formula, but it's a fixed interest rate and then also an inflation adjusted rate in there. So your own investment goals and situation will be different from mine. And so I'm just sharing with you the analysis that I went through for iBonds and the decision I made and why I made that decision to not buy iBonds. When you're looking at this video, the rate on iBonds, it will be different. It actually already is different than it was earlier in 2022 with that 9.62% because that rate changes. But I want to step you through the process that I went through in determining whether or not to buy those iBonds at that higher yield, that 9.62. And even now, iBonds still have a very nice yield. So the very first iBond disadvantage that I saw was that I like to set a goal, an investing return goal. In my investing course, this is one of the most important things that we do because I think what happens is that we feel like we have to settle for what's out there, or we sort of do what everybody else is doing or what we think we should do. But when we say, I'm going to use my money with certain expectations and I'm going to set a minimum goal, then I think we really, really approach investing differently. We can make demands of our money and we forget that. So I think it's important that we set that minimum investing goal for ourselves. My own investment return goal is roughly 10% on returns that are ideally taxed at something besides my highest tax rate. I sounded really Southern then. Highest tax rate. Knowing that my investment return goal beforehand is that it helps me evaluate any investment opportunity that comes up that everybody else is jumping on board with, including iBonds, without being distracted by the lure, the glitter of that 9.62%. So admittedly, a guaranteed safe income of 9.62% is it's darn close to my goal of 10%. So I was really, really tempted to buy those bonds. And I think a lot of people, this was probably a really, really good investment for them. Just didn't quite make sense for me. So that return wasn't quite what I wanted with the 10%. So that was the first disadvantage that I saw in the iBonds. Okay, iBond disadvantage number 2 was the real return. When iBonds had an interest rate of 9.62%, inflation was around 8%. Now, it was lower and higher, inflation moves around a bit, but it was very high. So it got up to around 8% when that bond was paying 9.62%. This means the real return before taxes was 1.32%. So just so you understand, the bonds were paying that 9.62% interest, but inflation, or the cost of things, was rising over 8%. So the real return, that's how we measure the real return. We deduct inflation from that interest rate. was only 1.32%. So that sort of deflated my excitement over these iBonds. Now, granted, more advanced investors may have bought iBonds anticipating lower inflation rates. Advanced investors may think this through and go, well, I think there's going to be deflation, so I think interest rates will go back down, the value of my bonds go up, and this will be a great investment. They could very well be right. In fact, I sort of think they will be right. I don't know. I sort of think they will. That's okay. For me, these disadvantages outweighed that possibility, or that maybe it's a probability. I don't know. The experts go, one says one thing that makes a lot of sense and another says another thing that makes a lot of sense. Nobody knows, okay? So I don't know if inflation will be higher or lower over the next few years since I broke my crystal ball, but this was, at the time I evaluated this was my thinking. Okay, iBond advantage number 3 was my after-tax return. The Treasury Direct.gov website clearly indicates that iBond interest goes on your federal tax return with other interest income. Most, if not all, of my interest income gets taxed at my highest tax rate. I already know that from looking at my tax returns. So after taxes had been paid on the income, my real return was solidly negative. So after I thought about inflation, took that out, not think about it, deduct it, because it's math, and math doesn't lie. Well, that's another video. There is a big story behind that 8% inflation, but using what we've got, we know that the return was what, 1.32%, and after I paid taxes on that, I had a negative return from these iBonds based on the income, and well, that just didn't excite me. So note that while iBonds are exempt from state tax, I live in Texas, so that was not relevant, and really I think it's sort of putting the cart before the horse to make investment decisions with this as a priority. So that was bond disadvantage number 3. iBond disadvantage number 4 was that there was absolutely no leverage. Now, wait a minute. Before you start thinking I'm crazy, I like to leverage time, money, or effort when I can. I apply this core principle to accounts, investment accounts, to taxes, and to amounts. So there is a $10,000 per person limit, or it's really tax number, limit on the number of bonds that I could buy. So it was a bit of a hassle to buy these iBonds in an account outside of our brokerage accounts, and we would have to buy them at Treasury Direct. Plus, I couldn't scale my efforts very much when it came to the amount of capital I was investing. And I know that all assets require tracking, they require managing, they require ongoing evaluation to ensure they remain worthy of our capital at any given time. And so this just didn't seem worth the effort. And I would have to have that other Treasury Direct account and all of this for a negative real return after taxes. So I didn't feel it was worth all the effort. iBond disadvantage number 5 was what I call the wealth qualifier. That's hard to say. The wealth qualifier. There's the world of traditional investing that leads to retirement planning and in an effort to make 4% retirement withdrawals. This would sometimes result in acceptable but probably not remarkable returns over time, to be honest, unless someone invests for a really, really long time frame and they're very, very disciplined and the markets are very, very favorable for them. And then there's the other world of investing, and that's how the wealthy invest. It's how the high net worth investors invest and their wealth managers invest for them. So one question I like to ask when evaluating an investment is this: will this use of my time and capital move the needle in terms of capital gains and or income? Is this what wealthy people are doing? Is this how they're investing? And I really didn't think that investing for a negative return after taxes and or a positive 1.32% real return would be the way that the wealthy invest, or that the needle would be moved for me when it came to our investing. iBond disadvantage number 6 was knowing the economy and the financial markets drive my investment returns. I like to consider the overall market cycle and the market for any asset I'm evaluating. I do this before buying an investment since I'm a more active investor. In other words, I don't follow that fixed little asset allocation model that disregards opportunities and elevated risk when they occur. These iBonds mature in 30 years. So even though I can cash in the iBonds before 30 years, the economics of the bonds are based on the economic conditions at the time of and just before the rates are determined. At the time the iBond rates were determined, there had been a 40-year declining interest rate cycle which had recently ended. So 40 years it's a pretty big deal. That's a pretty big cycle. So I'm going to think that through. That's a macro issue. And a rising interest rate environment had already begun when these bonds were issued. Even though the Feds sometimes pull back after they start raising interest rates and they lower rates again, and that very, very well might happen, I certainly didn't know for sure how interest rates would play out in the future. Few decades, 3 decades really, because this is a 30-year bond. Even though I'm not locked in, and I'll talk about that more, no one knows for sure. There's also the core investing principle, though, that when interest rates go up, bonds go down. The value of bonds go down. So if the Federal Reserve did need to continue rising interest rates, the value of these iBonds would go down since newer bonds would have higher rates. And even though I would be paid face value when I redeem the bonds, face value plus interest, if I wait 5 years or more, I would get all that. My capital would be tied up in an investment that had lost value relative to other potential opportunities because interest rates would be higher if interest rates were raised. This was a big iBond disadvantage to me. And then to add insult to injury with all this, I would be getting a negative after-tax real return. So I just wasn't real sure about this. Then iBond disadvantage number 7 I saw was that our investment capital would be tied up. Our money would have been tied into these bonds for 5 years if I wanted to avoid a penalty. That would be if I wanted to redeem the iBonds before the end of those 5 years, I would pay a 3-month penalty. Now, 3 months isn't so horrible. This is something that I could endure. So this wasn't a huge disadvantage. This was a mild iBond disadvantage, I would call it. And then iBond disadvantage number 8, it was opportunity cost. The stock market was in a bear market when these bonds were issued, and the real estate market was also entering a decline due to rising mortgage rates and other factors when these iBonds were issued. I consider myself probably an investor that's, been around a bit. And so I've invested through enough bear markets and real estate cycles to know that incredible opportunities to purchase undervalued assets surface after the bear market's end. The key to take advantage of these undervalued assets, though, at such times is having enough of your net worth in cash to be able to buy such investments. I wasn't sure that it was worth tying up our money suspecting that bargain assets were on the horizon. The next iBond disadvantage, I believe this is number 9, was that inflation may increase. So iBonds are meant to protect us against inflation. That's sort of the big thing about iBonds, that if you research iBonds, you'll read, they're designed to protect us against inflation. But wait a minute. The rate is fixed on the bonds that you buy. So if inflation kept going up, then how would that protect me? The rate was fixed at the time I bought the bond. So I felt that was a little bit not deceptive marketing, but just questionable as to how much these iBonds really would protect us if inflation got really high. And then iBond disadvantage, I believe I'm at number 10, was that there would be no income received while we held these bonds. So I like income generating assets. You may have heard the story how we stumbled into early retirement. We really like income generating assets because income pays the bills, not potential capital gains. So if I'm investing in an income type of asset, which bonds definitely are, I'm not planning on some big capital gain from an iBond, then I definitely want to get that monthly income. But with iBonds, you have to wait until you cash in the bonds to get the interest, and your money is tied up all that time. So I felt that that would be a pretty big disadvantage to owning these iBonds. Now, like I said, everyone is different. This was my thinking about iBonds and why I didn't jump on the iBond bandwagon like most investors did, or not most, many investors did. That 9.62 rate was very, very alluring. It's very, very tempting. But when I factored in all these other things, I wasn't sure it was the best investment for us at the time. You will decide what makes the most sense for you so that you can retire certain.